Hello and welcome to the channel. Today I'm going to continue on the series on financial instrument. In my last video I looked at the definition of financial instrument, and then I went ahead to look at the classification of financial assets and the classification of financial liabilities. And I ended that video by looking at the IFRS 9 standard, which says we need to apply impairment to financial assets using the expected credit loss model. Okay, so that is where I'm going to continue this video from today. So I have my working paper right here. So this is the working paper where I'm going to use to show you how we actually perform an audit of expected credit loss. But just so you know, I'm not going to rush into the working paper, okay, because IFRS 9 is a complex area and there's no point rushing straight to the working paper, because you can only audit what you know. If you don't really understand IFRS 9, you can't audit it, okay? So before we go to the working paper, I'm going to give you some other basic things that you need to be aware of, okay? So whenever you look at the financial statement of a company, so you can get the financial statement of a company from the website by just searching Google. So this is an example of a section. So when you look at the notes to the accounts, you're going to see a section called the significant accounting policies, okay? So under that section, they are going to tell you about their significant accounting policies, and one of such policies you are going to see is the financial instrument, okay? So I just took the financial instrument part to just show you. So they are going to tell you about how they classify their financial instruments. So can you see? They are going to tell you the measurement, okay, how they the initial recognition, how they recognize their financial instruments. And then the section that you're also going to see is impairment, which is where our audit focus is going to be on today. So can you see, this is the financial statement of a company, and here they are talking about their impairment, how they apply impairment to their financial asset, okay? So the readers of the financial statement are going to believe in us, the auditors, that we have actually audited the impairment of the financial assets. So that's why as an auditor, you actually need to understand the IFRS now, because if you don't, then you cannot properly perform the audit of expected credit losses, okay? So if you have any time, you can read through any company's financial statement and just read through their financial instruments section, okay? So that is one thing. The next thing I want to talk about before we go to our audit working paper is the IFRS 9 standard, okay? So this is the IFRS 9 standard, and I'm going to focus on the section for impairment. And then one thing I want us to know is that when we talk about financial instrument, you can see most people, when we talk about financial instrument, they just assume, oh, financial instrument is for large entities. No, financial instrument does not only apply to large entities, okay? It can also apply to even smaller entities, as long as they have items like receivables, okay? If they have like trade receivables, then financial instrument is going to apply to that company. So I want you to just remove your mind, because most people, when they hear financial instrument, they are scared and they think like, oh, it's for big companies. No, it applies to so many companies, okay? So that is one thing you should know. The other thing I want you to note is that IFRS 9 has given us the guidance on how to perform the impairment, okay? And we as auditors, we need to know what the standard says in order for us to be able to perform our audit. So the standard says we can use the general approach, okay? So we can use the general approach to perform our impairment, but you can see the standard here is saying that this approach is very complicated, okay? It's very complicated, so they don't really expect a lot of companies to use it, okay? Because it's just too complicated, so they don't, they won't expect a lot of companies to use it. So because of that, IFRS 9 has also provided another approach, which is called the simplified approach. As you can see right here, it said, however, it is not practical, for entities to apply the general approach, okay? So because of that, they allow companies to use the simplified approach when to test impairment of their trade receivables, okay? So, and that is what we are going to be, that's what I'm going to show you in my audit working paper, because in the audit I use the simplified approach when performing the audit. So that is one thing I need you to be aware of. Okay, so now we can go to our audit working paper right here. So in this video, I might not cover the all 5 steps. I might stop at step 3, and then in the next video I might look at the other step, because I don't want to rush this video. Okay, IFRS 9 is complex and we need to take it bit by bit. So here we have our working paper, and as you know, we have the company name. What we are testing account receivable, right? That's AR valuation. That's what we're actually doing. And then we have the year end, and here you can see some of my information. We have already set my materiality. So my materiality for this client is $51,000. Okay, and this will vary depending on, you know, the client you're working on. The PM, which is my performance materiality, and then I have my threshold. So as I go along, you're going to see where I'm going to apply this threshold. Okay, and just so you know, in this case my PM is 75% of my materiality. Okay, this is not the standard. It depends on the client. Sometimes we can use 65%. Okay, it depends on the client you're working on. So what is the purpose of this working paper? So I said to test the valuation of expected credit loss, okay, under IFRS 9. That is what I'm trying to achieve in this working paper. So what are my procedures? So if I'm going to audit, perform an audit of the expected credit loss, what are some procedures that I'm going to take? The first thing I said here is that I'm going to obtain management estimate, okay, because management need to prepare their own estimate before we are going to audit anything. Management has to provide us with their own estimate, because IFRS 9 requires, it's an area that requires significant judgment. Okay, so management needs to provide us with their own estimate of the expected credit loss. So once we get that, we are going to determine if management's assessment is appropriate. Okay, so that is what we are going to do. They've given us their estimate. Now we need to perform procedures to ensure that management assessment is appropriate, okay, by performing these 5 steps. And these steps, we are taking it from the IFRS 9 standard, okay. So I'll be going back and forth because the standard is very important, okay. Sorry. So can you see the standard here? The standard has told us the steps we need to take, okay, when performing the impairment. So we have step 1. So as an auditor, I'm going to follow each of these steps to be able to perform that audit. So we have step 1 right here, as you can see. Can you see? We have step 2 right here. It says determine the period over which observed historical loss rates are appropriate. Okay, so I'm going to show you how we actually audit each of these steps. So the step 1 says determine the appropriate groupings. Okay, and what does it mean when it says determine the appropriate grouping? So before we start looking at the other steps, let's go and look at step 1. So determine the appropriate groupings. Okay, so the ARL population should be aggregated by similar credit risk. Okay, so when it says determine the appropriate grouping, what it's trying to tell us is that we have to determine how we want to group the account receivable. Are we going to group it by days, like 1 to 30 days, or are we going to group it by, maybe for this particular client they group their AR by the types of customers? Okay, so just you have to apply your professional judgment. Okay, and let's see what the standard says regarding this. Let's see what the standard. So can you see what the standard is saying? The standard is saying there is no explicit guidance. So can you see that IFRS 9 is, it's an area that requires, use of professional judgment. You need to apply your professional judgment throughout the audit, because now the standard is telling you there is no explicit guidance or specific requirement in IFRS 9 on how to group the trade receivables. Okay, so you need to apply your judgment based on the client you are auditing. What would be the best way to group the receivables? Will it be best to group it by, in buckets like 1 to 30 days, 30 to 60 days, or would it be best to group the receivables by, customers, or any other factors that you think will be relevant? You can see in this case, you can group it by maybe the type of customer, wholesale, retail, whatever is best for you. Just make sure you apply your professional judgment. So in this particular client, this was the client assessment. The client said trade receivables are grouped based on the shared credit risk characteristics, okay, and the days they are past due. So that is what the client said. And for me as the auditor, I'm like, okay, I agree with the groupings by the client. Okay, the AR buckets were tested. I agreed with what the client is saying because I already performed my AR existence testing. Remember, this is valuation. I already performed my AR existence testing where we looked at the various buckets like 1 to 30, 31 to 60. And in my own assessment, I'm saying, yes, I agree with the client's grouping. So that's just step 1, determine the appropriate groupings, okay? Once you have done that, you know that, okay, this is the grouping I'm going to use, that is fine. And then what is step 2? It says determine the period over which observed historical loss rates are appropriate. What does it mean? What does it want us to do? Okay, now let's go back and look at the standard again. What guidance does the standard give us with regards to step 2? Okay, so here we go again. In step 2, the standard is telling us again there is no specific guidance. Okay, there is no specific guidance in IFRS 9 on how far back. So here when you get to step 2, you need to also apply your professional judgment, because if the standard is not giving you any specific guidance, what can you do? You can only just apply your professional judgment. So you can see judgment is needed. Can you see? Judgment is needed to determine the period over which reliable historical data can be obtained. So that was what I did. Okay, let's go back to our audit working paper. So when I was performing my audit, because I know that there is no particular guidance, I needed to apply my judgment. So the client's assessments, see what the client is saying. So the client is saying this is the various revenue stream that they have. They have wholesale, they have retail, they have online. So for the wholesale revenue, they had sales prior to 2021, but for retail sales, they didn't have retail sales until year 2021. And then for event sales, the client did not have event sales until 2021. So because of this, the client has given us the assessment that we should go only as far back as 2021. So they don't want us to go far back as 2020 or 2019 or 2018. Okay, so we as auditor, I'm going to check, do I agree with this client's assessment? So look at my audit assessment here. I said, per the client's assessment, it is reasonable to use historical rates for only year 2021. So I am agreeing with them because because they didn't have any sales in they only started the retail sales in 2021. There's no point going back to 2020. Okay, so remember, this is going to be different depending on the client you're working on. So remember, professional judgment you need to apply. So here I was just applying my professional judgment that there's no point going as far back as 2020. So I ended step 2 by saying I'm going to use just the historical rate for 2021. Okay, so now we are done with step 2, and then we'll go to step 3, which says determine the historical loss rate. Okay, now that you already know the period you want to go to, now determine the historical loss rate. Let's go back to the standard and see what the standard tells us to do. And here we go again. I'm sure you're not surprised to see that also in step 3, it says IFRS 9 does not provide any specific guidance on how to calculate the loss rate. Judgment will be required. Can you see? So IFRS 9 is, it's one area of auditing that I keep seeing judgment should be required, judgment should be required, judgment should be required. So I'm going to go back to my working paper again and show you how I applied judgment, okay, because the standard does not give us any specific guidance on how to determine the historical loss rate. Let's see my working paper, what I did. So let's go to step 3. So step 3 says determine the historical loss rate. So because I said I'm only going as far back as 2021, in your own case, you can decide, depending on the client, you can go as far back as 2 years or 3 years, but I only went back 1 year. Okay, so 2022 is the current year I'm auditing. So the client's year end that I'm currently auditing is 2022. So I only went as far back as 2021. So what did I do? I went back to the client's to the audit that was performed in 2021, and I looked at the account receivable. And remember, for this client, we are classifying based on different buckets. Okay, we have the 1 to 30 days, 31 to 60. So I took the account receivable for each bucket. That was for the year 2021. Okay, and after doing that, I also looked at the client's the work that was done in 2021, like the client's records for 2021. I looked at the bad debt. So how much bad debt did this client record? Okay, and I saw that for current they didn't record any bad debt, so they only recorded bad debt of this amount for receivables that were 91 days plus. Okay, so you need that information. So the information you need to be able to calculate your historical loss rates, you need the account receivable for that particular year. So if you are doing for 2 years, you need it for 2021, you need it for 2020. Okay, and then you also need the bad debt. How much bad debt did they record for that particular year? Okay, and now we can calculate our historical loss rate. Okay, so how do we do that? You just divide your you divide the bad debt by the account receivable. Okay, and then you get your loss rate. So as you can see, there was nothing here, nothing, but for 91 days plus we add 8%. Okay, so that means the client's historical loss rate is 8%, and you can see the historical loss rate for each aging bucket is 0%, except for this bucket right here, which has a historical loss rate. So for any receivables that is over 91 days for this particular client, they are likely to have a loss rate of 8%. Okay, 8%. And you can see this was the total receivable in the previous year, which was 2021. See, can you see I put prior year right here to show you that this is the receivable for 2021. So now that we have determined the historical loss rate for the prior year, we are now going to apply that loss rate. Okay, I'm going to apply that loss rate for the current year. So I told you the year I'm auditing is 2022. So I'm going to go to the client's financial records and then pick the receivables for the current year that I'm auditing. So I put the bucket for current, for 1 to 30 days, for 31, I put everything right there. I remember I already calculated my historical loss rate. So for here, because I know the historical loss rate is 0%, I'm just going to put 0, which is here. And then here I'm going to put 8. And then you know where I got the 8% from. I already showed you what I did here. Okay. So, and then I'm going to multiply that. You can see what I did here. I multiplied this by this to get the expected credit loss. Okay. So, yeah, an expected credit loss rate of 8% is expected because that was what I calculated here. I hope you're following me. It can be a bit complex, but I'm trying to make it as easy as I can. So that is step 3, determine the historical loss rate. And that is what we have done. To determine the historical loss rate, you need the account receivable for the prior year, and then you need the bad debt for the prior year. That will give you your historical loss rate. Okay, so that's step 3. So the next step we need to look at step 4 and step 5. And what is step 4? Step 4 says consider forward-looking macroeconomic factors. Okay, and then step 5 says calculate the expected credit loss. So we already looked at step 1, step 2, step 3. I'm going to stop that here for this video. In the next video, we are going to look at step 4 and step 5, and then I'll look at procedure 2, which is called the look back procedures. Okay, I'm going to show you how we perform the look back procedure. I don't want this video to be too long, so I'm going to stop right here, and in my next video I'm going to show you how I use my threshold, and then I'm going to look at step 4, step 5, and then look back. So I want to thank you for watching the video today. I'm going to see you in the next video, and bye.